Now that we have an underlying understanding of the accounting equation, let's go through a set of business transactions and see exactly how those transactions impact the accounting equation, see why there's a dual impact. Let's look at December 4th. Provide printing services to customers for $6,200 on account. Keywords: provide services. When a company is a printing service company or a service company, when we provide services, that's the piece of the company that allows us to generate revenues. It's very important to understand that. So when the company does its operating goal, print services here in this case, that's the way they generate revenue. Just like if you work at, let's say, a company and you go to work for an hour. When you go to work for that hour, you generate 1 hour of pay. So a company, when they work or do a service for whatever customer, they are generating revenues. Now, revenues we know fall into retained earnings. So let's go here and add our retained earnings under equity. Now, when we generate revenues, is that going to increase our equity or decrease our equity? Well, it increases our equity because we're gaining from those revenues. It brings us future benefit. And the company has claim, or the owner has claim to that as part of generating its own revenues. So revenue is part of retained earnings. Over to the side, if you want to put service revenue in the margin, just so you remember, that's perfectly fine as well. All right, now, did they pay us? There's two possibilities here. Either our customer paid us or they haven't yet paid us. So December 4th, it says that they performed the services on account. Now that's a very important word. That means our customers have not paid us yet. When we provide a service or sell a good on account, it creates money that is owed to us. Now it is an asset because it brings us future benefit. Eventually that account will be received as cash. But for now it's not paid, so we call that an accounts receivable. Anytime you're talking about a receivable, that means it is money owed to the company. And our accounts receivable here, our customer owes us more than they did the day before, so our accounts receivable is going up by $6,200. Again, notice that we are still in balance. All right, moving on. December 5th, we purchased $2,500 of supplies. Again, there's that word again, on account. The difference is here, it is purchased. Now, purchased $2,500 of supplies. Well, the cool thing there is the supplies is going to go up because we purchased them, so supplies are going up by $2,500. Now, when we buy stuff, we can either buy it with an account, a note, or with cash. Obviously, we did not pay cash for these supplies because it says on account. It doesn't say we signed a note, so it does not need to be added to a notes payable. We actually purchased them on account, so we can call it accounts payable. And we're going to go in, and I want to say, hey, now I owe an additional $2,500 on account. Our liabilities go up, our assets go up, therefore we remain in balance. December 10th, we provide printing services. There's those words again, and again, anytime we provide the service, we get to go in and recognize, let's see, December the 10th, we get to recognize service revenue. So we're going to go in and we're going to put a positive $4,500. Now again, anytime we provide services, we said there's two options. They can either pay us or put it on account. Here it says that we provide services for $4,500 in cash. So this means the customer paid us. Therefore, we received cash, so our asset cash is going to go up by $4,500. December 14th, we received $2,400 from a customer in advance for 1 year of services. Now we have to be careful here. Keywords, look for them. Receive $2,400. What does that mean to you? Well, that means we received $2,400. That means our cash of our company went up by $2,400. Now, what else does that tell us? Well, here's the problem. It is for services, but have we provided the services yet? We have not. We have done absolutely nothing to earn that money. So that brings me to the next definition or topic that we need to discuss a little bit, and that is revenue recognition. In its most basic form, now this is basic because there's more to it than what I'm about to say, but in the most basic form, we recognize revenues when the service obligation is complete. Now, service obligations can have multiple pieces or components, but in its very basic form, that's the definition of revenue recognition. We recognize revenues when the service or sale obligation, whatever the obligation is complete. In other words, you pay me, I complete whatever you paid me for, I get to recognize the revenue. Well, in this case, they're paying for 1 year of services. Have I done anything yet? Absolutely not. I haven't completed any of the obligation. So think about that. I owe my customer services. Now, where do we put things we owe? It's a liability, right? You put it in a liability. And here we have a specific name for it. And really, there's two names depending on what book you're reading. One is deferred revenue. We're deferring the recognition of the revenue until we actually provide the service. Another word that I've often seen for that is unearned revenue. In either case, whether your book uses unearned revenue or deferred revenue, that is an account showing that we owe, not money, that would be a payable, but we owe services to our customers. So we're going to go in and say, hey, I now owe this customer $2,400 worth of service over the next 12 months or 1 year. Okay? We cannot recognize it as equity yet because we have not completed any of the obligation to our customer. Okay, so very clear lines there. Just like the prepaid, we have to be careful of the recognition of items, whether it be revenue recognition or expense recognition. Okay. All right, moving on. We have just a few more transactions here. We'll hurry as quickly as we can. December 15th, we paid employee bi-monthly salary of $1,500. Keyword there, we paid. So we paid the salary. That means cash is going to go down. It's the only way we can pay for stuff. We can put things on account, but that's not paying for it. So paying means cash is going down $1,500. Now, employee salaries. Is that an asset? Now, I know employees can be considered an asset because they do bring us benefit, but we can't record them on the books. Don't think that. Do we still owe them or have we paid them? In this case, we've actually paid them, right? So it's not that, so it must be equity. In other words, we need the employee in order to produce the revenues. They assist us in that process. They are an expense to us. So when we talk about salaries, we're talking about retained earnings and expenses. Over to the side, again, you can note that as a salary expense so that you remember what component of retained earnings it actually falls in. Okay. The 20th. We collected 1/2 of the balance due from the customers on December 4th. So look back. Remember, our customers, we provided services on account for $6,200. What it's saying here is that we're collecting some of that. When we collect on an account, that means our cash is going to go up, and we collected 1/2 or $3,100 because notice they owed us $6,200 from December 4th. Then, as we collect the accounts, our receivable is going to go down. A lot of people want to add revenue here. We didn't provide any more services. We had already done that and already recognized the revenue. In this case, all we're doing is collecting on the balance due. In other words, now our customers no longer owe us $3,100, so we need to reduce the balance they owe us, and they paid it in cash. Okay, so be careful with that not to recognize additional revenue. December 26th, we paid $250 for an advertisement that ran this week in the local paper. Again, keyword there, paid. So that indicates that we paid cash, so our cash is going to go down by $250. What else happened for advertisements? Again, advertisement, is it an asset, liability, or equity? Well, it goes under equity because remember, advertising is part of the expense of doing business. It helps us generate revenues. So our equity is going to go down by $250. That's an expense account. As expenses go up, equity goes down because expenses reduce our owner's claims to the asset. Okay. All right, December 30th. We paid employee salaries. Here's that salary again. And we paid, so we know our cash is going to go down by $1,500. And then the offset to that, again, that's part of generating revenues. We have to pay our employees to perform the work, so equity is going to go down by $1,500. And last but not least, we paid $500 in cash dividends to the shareholder, DJ. Again, keywords paid $500. That means our cash is going to go down by $500. Okay. Now why? Because it's form of dividends. Where did we say dividends fell? Was it an asset, liability, or equity? Remember, dividends are part of the red accounts: revenues, expenses, dividends, and it is the payment of earnings to owners. So it's actually going to impact our retained earnings, and it's actually going to decrease our retained earnings. As we increase dividends, the more we pay out, the less in claims our owners have, because we've now paid out that claim to them. Okay? So dividends reduce our overall equity. All right, so once you have that done, we should be able to go in and look at the full structure here. Now, what I want you to do is take a moment, add up each of your columns to get some totals here. So just go right in here, add up the columns and create a total, and then add up all of these assets to make sure that we are physically in balance at this point. And that would allow us to see that our equation's in balance. So take just a moment to do that. All right, while you had it paused and we're actually adding these up, hopefully, I went through and did the same and added them up. So hopefully we tie if I didn't make any math mistakes. Now, take just a second again and add up those 5. And once you did that, hopefully you ended up with 56,850. We ended up with liabilities at 19,900. And we ended up with total, the sum of these two equity accounts, at 36,950. Sorry, about to type the wrong thing. Now, if we add 19,900 with 36,950, you come up to 56,850, which means our accounting equation is in balance. So please notice, when we do these transactions, there's dual effect, always keeping the accounting equation in balance. Hopefully, as you tried this, you did really well. Now we're going to move on to the next lecture, where we learn how to actually record these in the terms of debits and credits, which is what we really use within our system.